If there are modifications to a contract scope, price, or both of these, the modifications can either be treated as a separate contract or not. The modification must be treated as a separate contract if the two conditions set out in IFRS 15 paragraph 20 are satisfied. If either of these conditions are not satisfied, then the modifications cannot be treated as a separate contract. To determine how to further account for this modification, we need to determine if the goods or services are distinct, not distinct, or a combination of both distinct and not distinct. If the goods or services are distinct, then the modified contract would replace the existing contract. The revenue that was already recognized would not be adjusted, and the future revenue would be adjusted on a prospective basis. If the goods or services are not distinct, then the contract modification is treated as part of the existing contract. This would require retrospective adjustment. If the goods or services is a combination of distinct and not distinct, then the treatment would be a combination of the new replacement contract combined with the modification to the current existing contract. For example, UniX Limited entered into a contract with the Australian Army. The contract stipulated that UniX would provide the Australian Army with 5,000 military uniforms at a standalone selling price of $100. The contract indicated that UniX would deliver 1,000 uniforms every month over a 5-month period. At the end of the third month, the two parties agreed to increase the scope of the contract for another 500 uniforms to be delivered in the same month. UniX agreed to not charge for this additional uniforms. Should this modification be treated as a separate contract or not? The first requirement, which is that the goods or services be distinct, is satisfied since the uniforms are able to be used on its own and are separately identifiable. However, the second requirement, which is that the contract price should reflect the standalone selling prices, is not met since the additional uniforms are to be provided free of charge. Therefore, the modification cannot be treated as a separate contract. We now need to consider if the goods or services under the modification is distinct or not, as this would further affect how we are required to account for the modification. The additional uniforms are distinct goods, and so the modified contract would replace the existing contract. At the end of the third month, 300,000 revenue would be recognized. This is 3,000 uniforms delivered multiplied by the selling price of $100. We would not adjust this revenue already recognized, but would adjust future revenue. The total contract price remaining is $200,000, which is 2,000 uniforms multiplied by $100 each. However, the modifications now replace the existing contract so that the transaction price of $200,000 would be allocated over 2,500 uniforms. Thus, the selling price per uniform under the replaced contract is $80. That is $200,000 divided by 2,500 uniforms. So when the 500 uniforms are delivered in the third month, UniX would recognize a further $40,000 in revenue. This is $80 multiplied by 500 uniforms. In this example, we touched on all 5 steps in terms of IFRS 15. We first identified a contract between UniX and the Australian Army. In step 2, we identified the performance obligation, which was the promise to deliver uniforms. Step 3 was the determination of the transaction price, and step 4, we allocated the transaction price over the performance obligation. Prior to the modification, we allocated a transaction price of $500,000 over 5,000 uniforms. In the third month, there was a modification, and we allocated the remaining $200,000 transaction price over 2,500 uniforms. In step 5, we recognized revenue as and when the uniforms were delivered to the Army. To recap, when there is a modification to a contract, the requirements of IFRS 15 paragraph 20 must be met in order for the modification to be treated as a separate contract. Otherwise, it cannot be treated as a separate contract. A further question of whether the additional goods or services promised under the modification is distinct or not needs to be answered, as this would further affect the accounting treatment.